The International Energy Agency says that oil demand is weakening amid ongoing trade tensions and warning of a wider than anticipated supply surplus in the months ahead. That Thursday report coming as OPEC Plus output and tariff concerns pressure oil prices. You can see that action continuing. Brent currently trading just around $70 a barrel. Joining me now for more, Rob Thummel, Tortoise Senior Portfolio Manager and MD. Thanks so much for being here, Rob. Just talk to me about how low you think the price of oil could go here. I am seeing some calls this morning as low as $50 a barrel. Do you think that's a possibility?
Yeah, we'll see. I think oil prices probably range in the $60 to $80 range. Obviously, they're headed toward, been headed towards 60, not towards 80, and probably the last month, or actually really since the start of the year. So I think they could probably get down into the 60s. If they pop into the 50s, I think you're going to see producers in the U.S. start to pull back on drilling activity, and that will obviously lower the supply. The biggest probably upside potential, though, is, and I think it's something that nobody's not talking a lot about, is Iran, and sanctions on Iran will actually take supply off the global oil market, and so that could have an impact to push oil prices higher.
So how does that impact prices at the pump? This is something that Treasury Secretary Scott Bessent has talked about a lot, the desire for the Trump administration to keep those gas prices for consumers low. Do you anticipate that?
Yeah, I do think gasoline prices, have come down a reasonable amount, and I think they can continue to, and be at this low level. This is a really, $3 below $3, I think, is possible, and at the pump, and I think that's a good place to be for a lot of consumers around the U.S., because that will ultimately boost driving demand, and obviously, if driving demand goes up, then oil demand in the U.S. goes up as well.
Any risk of consumers seeing higher prices at the pump, oil getting more expensive for them?
Well, OPEC Plus has a lot of supply that's really curtailed right now that they could bring back to the market. And as I think you highlighted, they're going to bring back a little bit here starting in April, and then just gradually bring back some additional supply going forward. So if you're adding to the supply of the global oil market, that probably just helps keep prices lower and not cause them to go higher. So geopolitical risk premium has probably come out of the oil price right now. And that's probably one of the biggest things that would drive oil prices higher. But right now, there doesn't seem to be a lot of premium and built into the oil price.
So talk to me about any individual plays that you see in the space. I know Williams and Cheniere are some stocks that you're looking at.
Yeah, so at Tortoise, what we look at from an energy perspective, you look at the energy sector, we think the sector is really being redefined, and it's going to be less about oil in the future and more about natural gas. And so the future of energy is natural gas. Williams and Cheniere are great ways to look at the sector that way. Williams is one of the largest pipeline operators in the U.S. And one of the largest natural gas pipeline operators in the U.S. If you think about what natural gas demand is going to do, it's going to increase, we think, and increase pretty substantially for a long period of time. Part of the reason is because all these data centers need electricity, and they need reliable electricity, and natural gas supplies that. And so Williams actually is going to be actively involved in helping really build out this AI infrastructure. Cheniere is another option because Cheniere is the largest exporter of U.S. LNG. The U.S. is the largest LNG exporter, liquefied natural gas exporter in the world. And Cheniere is the largest liquefied natural gas or LNG exporter in the U.S. They've got a tremendous opportunity ahead of them. The company already generates a lot of free cash flow, and has high quality earnings that they pay out to shareholders, whether it's buybacks or dividend yields. And the growth in U.S. LNG demand is going to just be quite substantial. We think that LNG exports from the U.S. will almost double between now and 2030, and they probably go higher from there. So it's a great way to get into a stock that generates high quality earnings. Both of these stocks generate dividend yields, dividend growth, and buyback stock as well.